In one quarter, SEI Investments bought back $208 million of its own stock. That is not a typo. In a single 3-month period, a company with a $10 billion market cap returned 2% of itself to shareholders. And it was not even the most impressive thing that happened.
The most impressive thing was the operating margin. SEI hit 30% GAAP operating margin in Q1, up from 28% a year ago. For an investment technology and asset management company with 5,000 employees, that is the kind of expansion that rewrites what the street expects going forward.
Revenue came in at $622 million, up 13% year over year. They beat estimates, they beat on earnings, they set a quarterly record for net new sales that was 40% above the prior best. Ryan Hickey, the CEO, called it a starting point, not an end point. Today we're going to find out if he is right.
I'm Lana Chen.
And I'm Hudson Thomas. This is Charged Alpha, the S&P 500 stock encyclopedia. Today, SEI Investments Company, ticker SEIC. SEI Investments is one of those companies that does not have a clean 30-second elevator pitch. They are an investment technology firm. They are an asset manager. They are an outsourced operations provider. They are all three at once. And that combination is precisely the point.
The company operates through 5 segments. The Investment Managers segment, IMS, is the growth engine. It provides outsourced middle and back office operations, fund administration, and regulatory reporting for hedge funds, private equity firms, and alternative asset managers. SEI is the 3rd largest fund administrator in North America. IMS grew 15% in Q1 and carries a 39% operating margin.
The Investment Advisors segment serves registered investment advisors and independent broker-dealers with wealth management platforms and model portfolios. In Q3 2025, SEI paid $544 million for a 57.5% stake in Stratos Wealth Holdings, an RIA aggregator with roughly 1,200 advisor relationships, which rolled into this segment. Stratos contributed $20 million in revenue in Q1 2026.
The Private Banks segment serves trust companies and private banks with integrated technology and investment processing. The Institutional Investors segment delivers OEO outsourced chief investment officer services for pension funds, endowments, and nonprofits. And the 5th segment, Investments in New Businesses, houses emerging international initiatives that are currently running at a modest loss as they scale.
Total managed assets are $554 billion. Total administered assets, the money SEI touches operationally, is $1.29 trillion. Add them together, and SEI sits in the middle of $1.93 trillion of capital. The reason that number matters is that fee revenue scales with it.
The competitive moat here is switching costs. SEI handles fund administration, compliance reporting, portfolio accounting, and client reporting for institutional relationships that span decades. Replacing SEI means migrating complex, regulated operations across hundreds of funds. That is not something clients do casually. The company also has founder involvement. Alfred P. West Jr. founded SEI in 1968, retains a substantial ownership stake as executive chairman, and that long-term orientation shows in how capital is allocated.
The IMS segment winning 2 of the top 15 global alternative asset managers as new clients in Q1 2026. That is not a small deal. Those are multi-year, multi-$100 million AUM relationships at near 40% margins. Ryan Hickey became CEO of SEI Investments on June 1, 2022, succeeding the founder. That succession story is important context. He did not come in from the outside to disrupt the culture. He spent 27 years at SEI before taking the top job.
His background spans both sides of what SEI does. He served as Chief Information Officer, ran the technology unit, and was Managing Director of UK Wealth Management. He is both an asset management executive and a technologist, which is exactly the profile you want running a company whose edge is the intersection of those 2 disciplines.
The numbers under his tenure are striking. SEI's operating margin was around 24% when he took over. It is now 30% GAAP and 32% adjusted. That is 600 basis points of expansion in 3 years. Over the same period, the company has returned more than $1.5 billion to shareholders through buybacks and dividends.
The characterization from analysts is consistent. Hickey is a disciplined, technology-forward operator with deep institutional continuity. He is not managing for the next quarter. The AI investments he has been making in back-office automation are the reason the margin expansion is flowing through the income statement right now. Let's get into the financials. SEIC trades at $84.79. Market cap is $10.4 billion. Trailing PE is 15 times. Forward PE drops to 13.8 times on 2026 consensus estimates. Price to sales is 4.5 times.
That forward PE of 13.8 times is the number that grabs me. If the EPS growth rate for 2026 is somewhere north of 20%, which the forward estimates suggest, you are looking at a PEG ratio below 1. That is unusual for a quality compounder.
The Q1 2026 income statement walks like this. Revenue was $622 million, against an estimate of $614 million. That is a solid beat. Gross profit was $488 million, a 78% gross margin. Operating expenses of $299 million left operating income of $189 million. Net income was $174 million. EPS came in at $1.40 against an estimate of $1.34, a 4.5% beat.
11 analysts cover the stock. The average target is $104, which is 23% above where we are trading right now. The low target is 93, and the high is 115.
Cash flow is clean. Operating cash flow was $608 million on a trailing 12-month basis. Free cash flow was $585 million. The balance sheet carries $363 million in cash against only $43 million in debt, essentially zero net leverage. Current ratio of 3.3. Return on equity of 29%. This is a capital-light business with exceptional cash conversion.
On capital returns, the company paid back $1.04 per share in dividends this year at a 1.2% yield. The payout ratio is only 17%. There is enormous room to grow that dividend. And the buyback program is serious. $208 million in Q1 alone, $630 million on a trailing 12-month basis.
The record net new sales figure of $67 million, 40% above the prior quarterly record, is the leading indicator that matters most. New sales drive AUM growth drives fee revenue at 30% operating margins drives earnings. The pipeline is converting.
What is the segment story telling us?
IMS grew 15% to $220 million with a 39% margin. That is the engine. Investment advisors grew 24% to $170 million at 42% margin, boosted by Stratos. Private banks grew 11% at 21% margin. Institutional grew 4% at 48% margin. The only drag is new businesses, which is losing money at the margin as SEI invests in early-stage international initiatives. The diversification is working.
The health verdict?
Overall, SEI Investments' financial health is strong. Clean balance sheet, exceptional cash generation, expanding margins, record sales pipeline, and disciplined capital return. The only structural watch item is AUM market sensitivity, which we will cover in the risks section.
11 analysts cover SEIC, 7 have buy-equivalent ratings, 4 are holds, and nobody has a sell. The average price target is $104, implying 23% upside from current levels. The target range runs from 93 on the low end to 115 on the high.
There are a few notable calls worth knowing. UBS initiated coverage in February with a buy rating and a $115 target, the highest on the street. They called SEI the best positioned name in investment administration for the alternatives AUM growth supercycle, specifically flagging IMS's win rate on large alternative asset managers as underappreciated by the market.
Morgan Stanley maintained its overweight rating but cut the target from 119 to 108 on April 2nd. Their note was clear. This is a macro call, not a SEIC call. Tariff uncertainty hitting asset managers across the board. They cited SEI's capital light model and margin expansion trajectory as reasons to hold conviction through the noise.
Piper Sandler maintained their overweight and cut to 99 from 106 on April 7th. Same macro trim. But they upgraded SEIC from neutral to overweight back in December and held that upgraded rating through the April cut. Their rationale was the Q1 record sales pipeline and the IMS big name wins.
The last earnings release was April 22nd, 2026. Yesterday, essentially. Revenue of $622 million beat the estimate of $614 million. EPS of $1.40 beat the $1.34 estimate. No formal guidance for Q2 or the full year. Hickey said the momentum is a starting point and the IMS pipeline remains robust. Let me make the bull case. This is a company printing 30% operating margins for the first time in its history on the back of an AI-driven operational transformation. The IMS segment is positioned at the center of the single biggest secular shift in asset management right now, the flood of capital into alternatives. Private equity, hedge funds, credit strategies, they all need fund administration, compliance reporting, and portfolio accounting. SEI is one of 3 or 4 firms in the world that can service that at scale. You have a PEG ratio below 1. You have a balance sheet with net cash of $320 million. You have a management team that bought back 2% of the company in a single quarter at prices below current targets. The April analyst target cuts were macro-driven, tariff uncertainty across the whole market, not SEIC specific. Every firm that cut the target maintained or upgraded their qualitative rating. And the Q1 actuals just showed the business accelerating, not decelerating.
The bear case starts with the same number that anchors the bull case: $1.93 trillion of administered assets. That revenue base is marked to market. A sustained equity market drawdown of 15 to 20% does not just reduce AUM, it reduces the fee base that funds the entire operating leverage story. You cannot grow margins on a shrinking revenue base. Second watch point is regulatory. SEI Investments Europe is under an FCA supervisory review in the United Kingdom. Management has not quantified the exposure. If the FCA mandates operational changes in a material segment, the cost structure shifts in ways that are hard to model from the outside. Third, AI fee compression. The same AI that is expanding SEI's margins could eventually be used as a negotiating lever by clients demanding lower fees. If the productivity benefits are competed away rather than captured as margin, the expansion story reverses, and Stratos came in at 15% operating margins against a 30% corporate average. That integration has to work, or the investment advisors segment becomes a drag.
The 2 most direct peers in investment technology and fund administration are SS&C Technologies, ticker SS&C, and Broadridge Financial Solutions, ticker BR.
SS&C is the scale leader. $6.3 billion in annual revenue, nearly 3 times SEI's. SS&C trades at 2.7 times revenue and 22 times trailing earnings. SEI trades at 4.5 times revenue and 15 times trailing earnings. On paper, SS&C looks cheaper, but SS&C carried that scale through a decade of acquisitions and carries a meaningful debt load. SEI's 30% operating margin against SS&C's lower margins and higher leverage reflects the efficiency gap. Higher revenue multiple with lower PE is the market pricing SEI's cleaner capital structure and higher ROE.
Broadridge is at 2.6 times revenue and 17.8 times earnings. Broadridge's business is more tied to investor communications and proxy voting, a different secular story than the alternatives administration boom. Their revenue multiple is lower than SEI's because the growth vector is less powerful. The comparison tells you SEI's premium is explained by its position in alternatives administration and its margin profile, not just hope.
The takeaway: SEIC trades at a premium to both peers on revenue multiple, but at a discount to both on trailing earnings multiple. The market is saying SEI earns higher quality revenue, but has not yet fully repriced the earnings power that the margin expansion implies.
The options market heading into Q1 earnings was notably cautious. The put-call ratio was 1.93, nearly 2 puts being bought for every call. That is a skeptical positioning for a stock with a 2% short float.
Implied volatility was running at the 71st percentile of its 12-month range, significantly elevated above historical realized volatility of about 23%. The market was pricing in meaningful event risk at a premium. Given the post-earnings move of only 1 to 2%, well inside the implied range, That options premium largely evaporated for put buyers. The elevated put positioning read as macro hedging from institutions reacting to April tariff uncertainty, not a bet against SEIC fundamentals specifically.
Large open interest was concentrated at the $90 and $85 strikes in the near-term expiration. With the stock at $84.79, that $90 call represents 11% upside to the average analyst target range, and it priced in meaningful protection below 85 that turned out not to be needed.
The standard caveat: options positioning reflects short-term hedging and speculation, not fundamental value judgments. High put-call ratios in uncertain macro environments often resolve when earnings clarity arrives.
On insider transactions, 14 sales in the past 6 months, 0 open market purchases. Alfred P. West Jr., the founder, sold roughly 87,000 shares across 6 transactions for about $7 million. CEO Ryan Hickey sold approximately 80,000 shares for roughly $7 million as well.
The pattern here is compensation-related. West has sold shares routinely across decades while maintaining a substantial ownership position as executive chairman. Hick's sales represent a small fraction of his total SEI equity position and follow RSU vesting schedules. The absence of open market purchases is not unusual at a stock trading near prior highs where executives have concentrated equity compensation exposure. No transaction here reads as a bearish signal.
4 risks worth flagging. First, market and AUM sensitivity. The whole revenue model is fee-based on managed and administered assets. A sustained equity market decline doesn't just reduce earnings, it reduces the base that generates earnings. $1.93 trillion in combined AUM and AUA creates meaningful mark-to-market exposure.
Second, the FCA review of SEI Investments Europe, an open regulatory proceeding with unquantified exposure. Third, AI fee compression. The same productivity gain SEI is harvesting internally could eventually be competed away through lower pricing to clients rather than flowing to shareholders. Fourth, Stratos integration. The acquisition closed in Q3 2025. Stratos is running at 15% margins against SEI's 30% average, and the margin convergence thesis has to execute over the next 2 years.
The key metric to watch: adjusted operating margin. SEI hit 32% adjusted in Q1 2026, up from 29% a year ago. Every 100 basis points of further expansion at the current revenue run rate generates roughly $26 million of additional operating profit. If Q2 sustains above 30% gap, the first time the company has operated here, that confirms the AI efficiency story is structural, not a one-quarter event.
Also watch IMS net new sales for continuation of the big-name alternatives win rate. The 2 top 15 global alts managers won in Q1 are leading indicators for the next 8 to 12 quarters of IMS revenue growth.
SEI Investments delivered what the CEO called a defining quarter in Q1 2026. Revenue of $622 million, up 13%. EPS of $1.40, beating estimates by 4.5%. GAAP operating margin hitting 30% for the first time in the company's history. Record net new sales of $67 million, 40% above any prior quarter, and $208 million in buybacks in 3 months.
The stock at $84.79 trades at 13.8 times forward earnings against 20% plus projected EPS growth. A low one for a business with a clean balance sheet, 29% return on equity, and a structural growth engine in alternatives administration. The analyst target cuts from April were macro-driven, not SEIC specific. 7 of 11 analysts rated a buy with a $104 average target.
The one metric that tells you whether this story is real: adjusted operating margin. If Q2 sustains above 30%, the margin expansion is structural. If it slips back below 28, the Q1 result was a one-time event. Watch that number. Ryan Hickey put it this way on the Q1 earnings call: Q1 was not simply a strong start to the year. It is emphatic evidence that the strategic and operating changes we have made set a new standard for what SEI is capable of delivering on a sustained basis. The momentum in this business is incredible, giving us confidence that what we saw in Q1 is a starting point, not an end point.
That is exactly the kind of management tone you want to see. Not a victory lap, a forward commitment, The follow-through in Q2 and Q3 is what elevates this quarter from impressive to meaningful.
That's going to do it for this episode of Charged Alpha, SEI Investments Company, ticker SEIC. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities, no signup, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
If you found this episode useful, subscribe wherever you get your podcasts and leave us a review. It genuinely helps the show reach more people.
Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.